Hello, my name is Lindsay Shuck. Thank you for joining the Family Office Network's webinar series today featuring AgVest Advisors. I would like to introduce Chris Brawner, founder and president of AgVest Advisors, LLC, where he provides full-service U.S. farmland investment services to institutional and individual investors. Chris has been investing in U.S. farmland for over a decade and been involved in over $650 million of transactions. At the end of today's presentation, we will have time for Q&A. Please use your chat option at any point to send over questions so Chris can answer them accordingly.
All right, thanks, Lindsay. Thanks everyone for taking some time today to join the meeting. I would like to start today with a simple quote from Mark Twain, which I think is a very simple way to look at the macro story of why to buy farmland. So he famously said, "Buy land, they're not making it anymore." So we'll revisit this concept later, but it does relate to an interesting set of stats that are very promising for farmland investments. So as we get started today, I would like to invite questions, as Lindsay said, throughout the presentation. I think we'll have plenty of time at the end to have an interactive conversation. I do invite you to submit any questions that you might have along the way. So we're going to do a pretty high level look at the U.S. row crop farmland sector and how to invest in it and what the returns look like. So as we get started, we'll look at AgVest Advisors LLC, who we are, what we've done, how we do it. We'll look at the farmland asset class a little bit, the macro drivers, as we just talked about a little bit ago, and then also some historical returns that you can expect to see if you invest in farmland. Then we'll look in a little deeper dive into some investment options, the different ways to look at the investing, and then we'll look at how to move forward if you would like to have additional meetings. So who is AgVest Advisors? We were created in 2018. I myself am the founder, president of AgVest Advisors. To date, we have successfully invested approximately $30 million per annum for our current investors. We hold a real estate license with Farmers National Company. So Farmers National Company is the largest farm management company in the US. And so we are not employees with Farmers National, they're just our managing broker. They hold our license. So that gives us the option to use their network of real estate agents throughout the US. If we don't hold it within AgVest, license within a state, we can use the Farmers National network to get deals done in other states until we do get that license. We use consultants for boots on the ground, our network, build our network out. Our main consultants have over 50 years of farmland real estate and management experience. They're ingrained in their local markets, so each of these consultants have their own network built under them. These networks are ag bankers, appraisers, seed dealers, crop consultants, anybody that is in the ag industry. We like to build them into the network because, as we'll look at down the line here, the farmland industry is a very private deal sourced sector, so not everything is listed as in other real asset classes. So it's really important to get that local network built, and we've done that over the last 10 years. If you look just in the past 2 years as AgVest has been established, we've been presented with over $500 million of properties. And one of the main things that we do here at AgVest for the investors is we filter out those potential deals, and we pass right away on any deals that aren't going to work for our investors for one reason or another. And we only submit and present the potential deals that might fit for each individual investor to them. So we provide a full service investment support. We can work with investors to create investment thesis. We've done that with some state pension funds. If you already have an investment thesis and know the story behind what you want to do, then we can go ahead and skip to the next step where we source and filter farmland deals. As I said, we've been presented with over $500 million in the last 2 years, and we we filter out a bunch of those before we present those to the investors. We'll negotiate on behalf of the investor once the investor and AgVest are in line with what they think they want to pay for a potential property and what that lease rate might be. We provide the post-diligence post-contract. So this can vary by investor. Most of the institutional type investors that I've worked with are going to do a survey for properties. They're going to do an environmental phase 1. And about half of them I've worked with would have done at time of purchase appraisal also. So we'll coordinate all of those third-party reports during the diligence process. Then once it's owned, we'll manage the property. So managing a farmland property is very similar to having a property manager for an apartment building or an office complex. So we're going to negotiate leases. We're going to keep tenant relationships. We're going to have the relationships with the FSA office, the USDA, to make sure all the proper forms are filed. We're also going to, manage the soil on the farm, so to make sure that your tenants are treating your asset like they should to keep it as productive as possible. We work with an experienced farmland CPA. I've been working with them for over 5 years, so they know the farmland industry, they know the lingo, they know how it works, they know the timing. So they produce very good farm level financials for our investors. We have a relationship with an ag legal team, and some investors might want to use their internal legal team, and that's fine. But from my experience, using a group that's familiar with land deals in specific regions is very beneficial, as that'll cut out a lot of the negotiation back and forth during deals if they know kind of what's the norm in each region is. So the track record for AgVest management team, so like Lindsay said, we've been investing in row crop farmland for over 10 years, been involved in over $650 million of farmland investments. This includes investments in 13 states across the U.S., approximately, I would say, 170,000 acres through the 10 years. So we've invested in some of the largest financial institutions and pension funds. So the first group that we invested with, Goldman Sachs and Duquesne Capital, had a JV. They started a farmland REIT in 2007. And Duquesne Capital was Drunken Miller's group, and now I think that's evolved into Point State Capital. The Canadian Pension Plan, so CPPIB, which is one of the largest pension funds in the world, and Utah Retirement Systems, obviously, is a state pension fund from Utah. So we've participated in 2 of the largest U.S. row crop farmland portfolios and sales in history. In 2013, the Goldman Sachs Duquesne JV sold the portfolio to CPPIB, and we managed that process. And then in 17, CPPIB sold the portfolio to the Gates Foundation. We've also assisted a large ag consulting firm, helped them write an ag investment thesis for a state pension fund. That state pension fund is now actively investing in the row crop farmland space. We've proven that we can consistently deliver below market deals to our investors. So we'll do a quick snapshot here of the farmland asset class, just in order to show why a group like AgVest is needed to do a direct investment in the ag space. So if you look at the U.S. row crop farmland asset class, it's a very inefficient market. It's predominantly private deals, so you're not going to be able to go to listings. There are a lot of listings out there, but to get the good deals and build a very high quality, good return portfolio, you really need to do a lot of private deals. So in AgVest, our current groups that we are investing for the 30 million per annum, roughly 65% of that value has been through private deals that were not listed to the public market. So the farmland market has not been institutionalized the same degree as other asset classes. It's kind of a non-traditional asset category for institutional investors at this time. Like I said, it's very private, so it makes it difficult for institutional type investors to get good quality deals if they don't have boots on the ground that are ingrained in the local markets to get those private deals. Also, once the farmland is owned, like I mentioned earlier, you need an expertise in the farmland industry to manage that farm. So you need, like I said, you need to keep track of the nutrients in the ground to make sure that your tenant is not paying a high rent and you're getting a good return, but you don't know that he hasn't, put the proper nutrients on the field for 3 years because he's saving money that way because he's paying you a high rent. And then year 4, he walks. And when you bring a new tenant in, he tests the ground and tells you you need, a good capital expense of nutrients put back in that farm before he's going to pay you a market rent. So you need to watch that. You need to manage the relationships with the government offices such as USDA and FSA, and obviously the tenant relationship with the lease negotiation and rent collection. So at AgVest, again, there's 2 parts to this business. So we help institutional type investors acquire investment grade farms, and then we also do the portfolio management. And just real quick, I've went over this so far. Sourcing network, again, over the past 10 years, we've built a very vast sourcing network throughout the U.S. Proven team, like I said, we worked for some of the biggest pension funds and financial institutions in the world. So we've successfully invested for them, and now, with the state pension fund, successfully investing for them also. The portfolio management part of it, again, in the last 10 years, we've built the network. We've worked with hundreds of tenants throughout the U.S. So we have a backlog of tenants for any institutional type investment grade farm that we can buy in an investment grade area. We will have a backlog of tenants to fill that in case anything happens to the main tenant, so that that farm is always farmed by a good tenant. We have the outsourced variable cost model, so accounting, again, all legal, consultants, all variable costs there. And then other revenue enhancing activities, such as ancillary income activities such as grain bins, grain storage on the farm, wind turbines on the farm, solar farms, different things like that we can present to our investors. So the acquisition process, just again, a very high level depiction here of what we do. But we talk with our source points daily, and they're bringing us deals. And a lot of them we have trained that which investors we're working with and what they're looking for in regards to location, size, return, crop type, all of that. So we're in communication with them. They bring us deals. Again, we filter out a good portion of those so the investor doesn't waste his time on them. Once we see a deal that has potential for an investor, then we do our initial diligence. We'll pull aerial maps, soil maps. We'll look in Google history back at all the historical photos of the farm where we can see if there's a reoccurring problem. So if there's a 10-acre ponding issue every year on this farm, we know there's some drainage issues that we might need to account for in the model. If it looks good most of the time, then we know that the drainage looks pretty good and looks to be a good farm. So we'll look at all the historicals, we'll pull the soils, so we'll see what kind of productivity it should be. We'll know the areas, so we'll know if the tenant strength is good in that area. We'll know if the end grain market is good and how the rental market is. So we then talk to the investor and those potential deals. We'll put together a packet with some of that information, depending on how much information the investor wants. And we will present that to the investors with a model that has, what AgVest would view as the lease rate that's sustainable on that farm, and that will go along with the max price that AgVest would suggest paying for the farm. So we'll have a back and forth with the investor on those, and that discussion, once AgVest and the investor are in line with the lease rate and max price, and AgVest will negotiate on their behalf. So again, it matters with the diligence and how much diligence the investors will want to do, but I think there's a misconception on a lot of investors that buying a farm will take 6 months. We can do this whole process from the time AgVest gets the initial lead to closing a farm if it's an area that we know well, and there's not any problems, and we can do the whole process in as little as 45 days. So most of the time with the institutional type investors, we're going to close a farm somewhere in that 45 to 60 days from initial lead. So it's a real quick snapshot here. Again, just to show the deals that are brought to AgVest and how we filter them out. So this is an 18-month look back of AgVest. We have received roughly $440 million of farmland leads, and a lot of those we write off right at the beginning for different reasons. So approximately half of those we took a deeper dive into, and we either presented them to investors or at least had a discussion with investors. And we contracted 38 million of that, of roughly 222 million. So if you look at success rate, if you say success rate is contracting the deal, roughly 9% of the total deals that we see we got under contract, and 17 of the deals that we actually took a deeper dive into. And I'd say that's right in line over the past 10 years with the institutional type investors, somewhere in that 5 to 10% of deals that we see we were successful on. And I would say that's about right. You don't want to, drive that too low. That probably means we're being a little too picky and, not going to buy a lot of farms that way. But you don't want to also drive that really high. That would look like we're buying, anything and not being as picky as you should be. But really, that's up to the investor. If they have a large amount of capital they need to get invested, then we can open that funnel a little more. So we'll get out of AgVest now, and we'll look into the farmland market. So one of the smartest guys that I've worked with in the last 10 years, an upper level guy at Goldman, early on in this process told me he described farmland as gold with a coupon, and I've always remembered that discussion with him and how he explained it, and I've always just kind of gone back to that, and it makes a lot of sense. So it's it's a real asset, it's tangible, you can touch it, you can go visit it, but you're also getting a cash yield off of it every year. So I've always liked that saying. So if you want to dive in a little bit here to the macro and micro, I guess, economic look at your farmland investments. So your key drivers to farmland investment, as we talked about earlier, your farmland acres are decreasing throughout the world. So farmland is being switched to housing complexes, subdivisions, office space, industrialization. They're not taking apartment buildings and office buildings and tearing them down and making farmland. They're doing the opposite. So your farmland acres are finite, and they continue to go down throughout the world. Global population, on the other hand, continues to rise. So you're taking less farmland acres and you're adding more people. And then your third main driver is your developing countries are eating more protein. And so that protein requires more grains to feed the protein. So you're adding more people, you're adding more meat consumption, and you're taking farmland acres away is kind of the macro story of why you would buy farmland. Farmland investment performance, so it has a history of solid returns. Again, you get appreciation along with an annual cash yield, very low volatility. We'll look at that. Inflationary hedge, it's resilient to recessions, as is why it's important to look at that at this point, which we don't know what what the market holds for us in the next year or two. So here is just a visual of what I've already said. If you take the orange line, which might be a little difficult to see on this graph, going from left to right, that's your arable land per person, and that obviously is on a downward trend. And you take the blue bars, which is your projected population in the world, and that's obviously on an upward trend. So it's exactly what I said before. You know, with the industrialization and urbanization throughout the world, this is going to continue on this trend, is why, you know, farmland is going to be a very valuable asset as we go forward. So this is an INCREEF chart. So just real quick, INCREEF is an index that contains properties throughout the US. They get data from them. It's really the best and only standard benchmark for the asset class. They've done a good job of building that in the last few years, and they get properties in from the big funds, and they get their data in order to have a benchmark for the industry. But if you look at this, you know, the dashed line is your total return for farmland from 93 to 19. As you can see, there's some slight peaks and valleys, but very consistent along the way. You look at the blue line, that's your S&P 500, and obviously there, the peaks and valleys are much greater. So, you know, right now we're in the longest bull market in history. But as you can see, the dashed line is still above the S&P 500 for a fair amount of that time, where the S&P is really successful. So just as a takeaway here, you know, it's very consistent. You're not going to have huge dips and valleys. It's just going to be a consistent performer for you. So if you look at farmland returns, just the cash return versus your 10-year bonds, different government bonds. So as you can see, roughly 4.3% of a cash yield over the last 10 years. And, you know, that's over double any of your government bonds. So again, just very consistent, low risk, low return type investment for you. So the next two slides here, I think are very interesting. Again, these are INCREEF data, and these are interesting in that, you know, they look at different time frames. So a 25-year is your green, 20-year returns, your yellow, 15 red, and then the light blue is a 10-year return. So you can see through the different cycles and different time frames what farmland has done versus your other investment opportunities. So this first one, you look at your returns, and the only one that beat farmland barely was your Dow Jones REIT index for 25 years is barely above. And the rest of the time frames, farmland has outperformed your other investment opportunities. So to go along with that, though, the next slide, again, the volatility is just very low. So other than your, you know, your 1-year CDs or your AAA bonds, farmland's right there. It's going to be consistently low volatility. So if you combine those two, again, it's just a very consistent, low volatile investment that's going to just continue to give you a consistent return year after year. So to get into some numbers, you know, again, U.S. row crop farmland investments, I would say, are as close to a risk-free investment as you can get. So occupancy rate is 100%. So this, as a caveat, this is 100% if you are buying investment grade farms in investment grade areas. So there are some groups out there that I've seen that are in the market that are promising higher returns than they're actually out in the market, but they're going to remote areas to get those returns. And, you know, when you get into remote areas that aren't investment grade farmland, you're also getting into a tenant base that's not investment grade, and maybe there's not a bunch of them around. So I've seen groups get into trouble where they buy a non-investment grade farm in the middle of, say, Montana, and, there's two people out there that can farm that farm, and if one of them goes down, the other guy obviously has a pretty good negotiating factor on you for your rent. So things like that, you just want to stay in the good farmland areas that have, if I have a farm in central Illinois and I have a farmer retire or for whatever reason can't farm the farm the next year, if it's an investment grade asset in central Illinois, I'll have, I could call 25 guys in the next hour and get, within a day, I would have quotes from them on what the rental rate they could pay for the next year. So the occupancy rate is 100% if you stay, like I said, in those investment grade assets. Your rent, we'll look at some rent structures later, but the most predominant one that I use that I like is a fixed cash lease. So you're paid in full in February. So there's no risk of non-payment because the farming season in most parts of the US is going to start in late March, April into May. So we're getting paid in February. So if there's a non-payment for any reason, again, we'll move on to the next guy and still have a month or two to be able to negotiate that so they don't, we're not late in the game where they can have a negotiating leg up on us. So we've successfully implemented that over the past 7 or 8 years. We've really tried to change the market in that way, and all of the investments that I'm managing currently in the Midwest, they all pay us in February. We're completely, for all my investors for 2020, we've received all of our cash rent for the year. So the long-term appreciation of row crop farmland, if you look at USDA numbers that we've always used, it's 6.1% per annum. Net cash yield, we're kind of in a lull down cycle of the grain markets at this point, and we are still getting 3 or above net cash yield on the farms. So right now, the farms we're buying are in that 8 to 9% IRR, and again, we're in a down cycle. So historically, what I've seen is that 8 to 12% IRR, 3 to 4% net cash yield, and then you can look at the 6% per annum appreciation. So if you're looking and thinking about investing in farmland, there's main things to think about here, and we can go deeper into them if you would like, but you need to look at your duration of investment. So timed investment versus long-term. So I've seen a lot of funds throughout the past 10 years that come into the market and they have a 7-year fund life and they're buying farms. And we'll look at the economics of a fund later actually versus direct investment. But those funds get into trouble when they buy for a couple years and then they have that fuse on their investment and they have to sell in year 7 or 8. And in farmland, it could be cyclical in that they have to sell during a down market and they have no other choice. So I don't really like the timed investments for farmland, but there are people out there doing that. Your desired risk of return versus risk versus return. So again, your easiest and best low risk tool is that cash lease that you get paid for up front. You can get involved more in the crop on different types of leases and take a little more risk with the farmer. In row crop farmland, I'm not sure that's worth the risk. There's not as much upside. Now, if you get into permanent crops, that's predominantly what they are, is you're participating in that risk with the farmers in the permanent side. But most of the time in the row crop farmland, you're going to be a passive investor. The investment size, again, how much capital you want to deploy, over what time period you want to deploy that, and then again, cash flow, your lease types. Do you want to set your leases for each year and reset those every year, or do you want to take a 3-year lease and lock that in for the security of that? So with all of those things that you have to think about when you're looking at investing in farmland, at AgVest, that's what we do, is we can personalize your investments. So we have, as I've mentioned, the extensive network throughout the US. we can create a personalized investment portfolio for you. So, you might be sitting in Ohio right now and you want, to own $10 million of Ohio farmland in the next 3 years. So, we have guys in Ohio, we can start looking there. We might be sitting in California, but you want to own the best row crop farmland there is in the US, and that would be in Illinois. So we can build a portfolio like that. I've also worked with a group, one of the largest permanent crop investment groups in California, and I've done a mixed approach for some investors. So they want to be involved in the permanent crop side, which is a little higher return, but again, that's a little higher risk also because that's an active investment in the crop. But then they also want the very low risk, lower return stuff that the row crop farmland has. So we will work with that group and create a mixed portfolio of the two types of farmland for investors. So a lot of people like that, and I think that's a very good idea for guys that have quite a bit of capital to put to work. Again, the size, both individual deals and portfolio. So some investors don't want to look at anything under, $2 million. Some investors will buy anything, over $200,000. So we can look at all different sizes. You can build your portfolio to the size that you want to get it to, the time that it takes to get that deployed, the type, if you want to go, look at irrigated farmland where water is plentiful, say in the Delta, Mississippi Delta, we can look at that. Or if, water is a big headline in the past few years, especially in California, if you want to go somewhere where water is not needed to grow the crops, such as Illinois, where they just rely on natural rainfall and grow, the best row crops in the nation, then we can look at that too. So, and again, you can mix and match, but just a note here that, we have the network around the US to build the portfolio that you want to build. You're not locked into one region with us or one type of crop. So just a couple examples here real quick of deals. So again, these, as I talk about private deals, this is one we did last year. So a family operation, they're looking to grow. So they knew one of the contacts at AgVest. So for growth capital, they came to us. We worked out the deal where they sold 1,000 acres. They used those proceeds to 1031 tax-free into additional farmland, and the investors got a reasonable lease rate, and the farmer grew their acres. So they came into this deal farming 2,000 acres. They walked out of it farming 3,000 acres, and that's just an example of one way that farmers look for investors like this for growth capital to be able to grow their operation without using all of their capital in the land. Also get a lot of deals through tenants where they have a landlord family in Chicago, say, and they're farming in Central Illinois. They've been farming for them for 25 years, and the patriarch of the landlord family dies, and the kids are living in Chicago, don't necessarily want the farm. So they go to the tenant and give them the first opportunity because, the dad always went down there once a year and liked him and rode in the combine with him. So they give them first opportunity to buy that farm. And then, in that situation, again, they would come to an investor type like us to be able to try to go buy that farm for them, and then they continue to farm it. So just a couple open deals that we have right now, just to show the pipeline is still going here. We have, a couple of these are on the bigger side. I would say most institutional types, and where we've had the most success in our history is in those farms that are, say, $2 million to $5 million farms. So once you get above that 2 million, the neighbor farmer, that starts to be, a pretty big purchase for them. But your big guys, say, is like a Hancock, they usually don't pay much attention to things that are under about $5 million. So that $2 to $5 million price point for farms seems to be kind of a sweet spot of where investors can get good deals but still build a meaningful portfolio. But these are just some deals I have in a pipeline right now that I'm looking into that seem to be potential deals for someone. All right. Again, I mentioned this earlier, different types of leases that you can have on row crop farmland. The fixed cash lease, again, is just paid up front. It's just a straight dollar per acre number, and that pays for the year. What I like to do and what we have at AgVest predominantly, especially in the Midwest, for our current investors is the second type of lease here. So it's a variable upside cash lease. So it's a cash lease in that you get all of your money in February for the year on your cash lease. So it's the same there, so there's no risk. But then it has a variable component on the back end. This allows for investors to lock in a multi-year lease without that risk of the grain market going up and then losing out on resetting that lease rate. So say you got a 5-year lease on a farm, you do a fixed cash with a variable upside, and the grain market stays relatively flat for the next couple years, so there's no upside. But then in year 3, something happens and the grain market explodes, similar to 2012-13, and people that are setting their lease rates at that time are going to have a higher lease rate because the grain market's up. Well, in the upside calculation, that takes the grain market is what will trigger that if it goes up. So the investor gets to participate in that upside, but still get the cash rent at the beginning of the year risk-free. So that's what we have right now, and that's what we use. That's the farmer likes it because, you know, if prices do go up and they have to kick in that variable upside, that means that the grain markets have recovered and they're doing well and they're making more money too. So that's the most fair way that I've seen. And like I said, it really allows for investors to lock in multi-year leases rather than resetting them every year. A couple other kinds of leases here that aren't as prominent. You can do a net share where you get a percentage of the crop that's raised on your farm. You can set a bushel lease. We have some of these around the Midwest I've seen where you and the farmer agree on you get X number of bushels a year. So say you get 100 bushels a year, you can market those yourself. It gives you some marketing power in marketing your grain. And then custom leases. Essentially, you act as the farmer. You pay all the inputs, you get all of the crop, and then you just pay a fee for the farmer to actually farm your ground. So that would be the most risk, obviously, as you're participating in the crop fully there. So I mentioned before, ancillary income opportunities. These are just a couple that are coming around. So wind energy is becoming a big deal, especially in Nebraska, Illinois. I've done a few of these deals. So these are very friendly for the farmer also just because they don't take up a lot of acreage and they're not hard to farm around. And for the investors, I've seen where turbines can produce up to $25,000 a year as additional income on a farm. So wind energy is becoming a lot more prominent, like I said, especially in Nebraska and the Midwest. Solar energy, I've done some of these down in the Delta. These obviously take farmland out of production, so these are good for if you have a farm that has some lower quality areas. You can put solar farms on those. Returns vary greatly, no matter where you're at and how big you can get it. Grain storage. Farmers like grain storage on their farms because that extends their marketing window. If they can put their grain in a grain bin on their farm, they don't have to sell it straight off the farm, so they don't have to take the price that it is right then. They can store that and they can market that grain ahead of time, and you know, for a delivery a couple months after harvest when the price gets better because there's less supply there. So real quick here, I will go through this pretty fast, but there are a lot of funds out there that are looking to get investments and build a fund and buy farmland. And I was associated with one of those for a little while. And here's just a look at the economics. So if you look at a fund and you're looking at this traditional 7-year fund, you know, they can charge anywhere from 1.5% to 2% on committed capital. So even before they're putting the capital to work, they're going to likely charge you that fee on that money, even though it's not even at work yet. A direct, obviously, like going through AgVest, you're only paying for success essentially. So you're guaranteeing a certain percentage of say a commission on successful deals, and then you're paying a management fee. That's a percentage of revenue. So just a quick snapshot of what it would look like to place $30 million over 7 years. You're going to pay over 3 times the fees to a fund that you would just going direct. And the fund, the other problem, like I said, one problem is you have to sell if it's a timed fund. The other problem is, as an investor, you're going to want them to place that capital as quickly as possible, since you're getting fees on it when it's not in use yet. So that doesn't always lead to the best deals. If you're wanting them to place 30 million in a year to get it to work, but the market's not giving you 30 million of good deals, then you're going to end up with a below average portfolio. And if you look at the direct investment, since you're not paying for anything until there's a success, then you can take your time and actually pick properties that make sense and that are good deals, where you can build a very, very good quality portfolio. So just to wrap it up real quick here, this is a very high level presentation of the asset class and kind of the procedures of what we do at AgVest. If there's any additional items that you would like to discuss, there's a bunch of different things we could go a lot deeper into, but feel free to contact me and we can go over those.
Great, thank you so much, Chris. Again, now we would like to open the dialogue up for any questions. Please use your questions drop down and submit those over to us so Chris can answer them accordingly. We did have one question come in that Chris Abbott was asking if he would be able to get a copy of the slide deck from you. And myself, Lindsay at Family Office Networks, will be following up with everyone individually, and we can get all the materials that you request at the end of the presentation as well. But again, please submit some questions over so we can ask Chris. Okay, looks like Gavin Taylor, he says, is there any thoughts on vineyards as farm type investments?
Yeah, that would fit more in the permanent type investment. That's one of the main things that my counterpart in California does. He manages a lot of vineyards in California, so I think he likes certain types of vineyards. Kind of that mid-range wine is kind of where he focuses. So not the real cheap stuff, but not the super expensive stuff. But he has a lot of vineyards that produce kind of that mid-range quality. But that would be more in his expertise.
Perfect, thank you. What is the impact of commodity prices on the IRR of the investments?
So commodity prices are going to drive your lease rate, which obviously would be an impact on the IRR. So the good thing about working with progressive good tenants in good areas is they're marketing things up to 2 years ahead of time. So I have farmers in Illinois right now that they have sold over $4 corn for 2021. And the market right now sits at 330, and everybody looks at the grain market and how low it is and how our farmers going to make it. But the good ones that we work with are going to be locking in, break even or profit up to 2 years ahead of time, so that our lease rates that we establish at the beginning can be sustainable for them. Therefore, we don't have to re-rate our farms every year if commodity prices, say, go down like they are right now. We've already established that lease rates that's sustainable for them. So in that regard, it wouldn't have any impact. Now, if grain prices stay down for 10 years, which is doubtful with all the macro stuff that we looked at, then that would have an impact because you would have to lower your lease rate. But in working with good progressive tenants, you're going to work out that lease rate at the beginning that's sustainable for them and how they're marketing their grain.
Joaquin has a question. What will be the impact of plant-based meat on amount of land needed to provide protein for human compensation?
Oh, I think that's still up in the air, I guess, on how successful that'll be long term. So I don't have a great answer for that, honestly. So, it's going to take more plants, obviously, but we'll still need to feed plenty of protein to feed the world too. So that one's really, in my mind, still up in the air on how long-term sustainable the plant-based diet will be.
Okay, great. Charles has a question. What acquisitions have you done in California? How is the water situation in California affecting your decision to invest in California?
So as far as row crop farmland, we have not done any in California. Again, that's more of the permanent crop space. California is predominantly a permanent crop state with almonds, vineyards, walnuts, pistachios. So we as AgVest have not done anything in California.
Okay, and Ryan is asking, how will the fallout from the virus affect AgVest investing?
To this point, it hasn't really impacted us at all. I mean, our investors are still active. They're still looking at deals, still closing on deals. As far as our farmers, other than the grain markets being down, they're still going about their farming practices as they would before COVID. So at this point, it hasn't had any impact on our current investors.
Okay, great. And Chris asks, what kind of investor is currently interested in investing in farmland?
I'm working with pension funds right now. I've worked with family offices in the recent past. It's really anybody that's looking for that. This is really another place to put cash. This isn't an investment that you're going to make 100% return on in 5 years, like some tech stock or something. This is really just another place to look at, instead of bonds or different things. Where are you going to put cash and make 3 to 4%, but also get that appreciation play on essentially a risk-free asset?
Okay, and do you have any commodity hedging or outsource it in any way?
No, because as our current investors don't have any active leases, so again, they're all passive. So our farmers, that's why we again work with the most progressive, best farmers, and they're in complete control of their marketing of their grain.
Chris, thank you so much for giving such a high-level overview of AgVest Advisors. We will be following up with everyone after today to see if there's any other questions outside of this webinar.
All right, thank you guys.
Thanks, Chris.